It's Money Management Monday, and today we're talking about how to manage your debt-to-income ratio. Mortgage Loan Officer Nikole Reece from Dow Chemical Employees Credit Union is here with us. Thanks so much for being here.
You're welcome.
All right, so first of all, what is the debt-to-income ratio?
It is a percentage of your required monthly debt payments in relation to your gross monthly income.
So why is something like this so important to know?
Because lenders use it to determine how much you can afford for monthly payments, whether that's for a mortgage or a car loan or a credit card. And it also will just, the higher your debt to income ratio, maybe the more difficult to make your payments and continue a certain standard of living. So it's something that's very important, both for people just to know in general, but also if you want to get any kind of loans or credit cards or mortgages.
So important to know. So how would someone calculate the ratio?
You would look at your monthly debt payments, so your minimum required monthly debt payments. That would be credit cards, mortgages, loans, student loans, and then also you would take into consideration your homeowner's insurance and property taxes if you break it down by a monthly amount, and include that as well if you're a homeowner. And then you would take that total dollar amount and divide it by your total gross monthly income to get your total debt to income ratio.
So you mentioned this a bit, but how can the debt to income ratio affect someone's ability to get a loan?
The higher your debt to income ratio, there's a certain limit that lenders look at. So a lot of times that's in the 43% range. So if your debt to income ratio goes above 43%, the higher it goes, the less likely you are to get financing. So you definitely want to keep an eye on it. Keep it low enough that you have some wiggle room there if you need to get a loan for any reason.
So what's considered a good ratio?
43% is a pretty standard threshold. Lower than that is ideal. A rule of thumb could be 36% is what I've heard that thrown around. But to get a loan, 36% is perfectly fine. You can go up to 43%. Sometimes there's some wiggle room, but that I would say if you can keep it under 43, that would be ideal.
All right, perfect. Well, thank you so much for joining us today and letting us know about this and how to calculate that. And if you at home want some more information on today's topic, check out the hot links section on WNEM.com.